Digital currency, what is it? And what's behind a lot of the speculation we hear out there in the media, thinking that it's going to somehow be the end of the U.S. dollar. We'll talk about all of that on the program, plus some surprising statistics that you might not be aware of when it comes to your retirement. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio programs, also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite platform. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, that stand ready to help you change your life with a successful and cost-effective financial plan. So before we get to the digital currency and some of those retirement statistics that you may not know, I thought we would do a little bit of follow-up on some of the things that we talked about last week on the program. So we got some follow-up conversation on inflation. We've got some follow-up conversation on the IRS, only appropriate now that the tax season has come to a complete. Although if you filed an extension, it's not really complete. It's just like dragging on and on and on. But anyway, for the vast majority of Americans, this past Tuesday, April 18th, was the tax filing deadline. So we got some interesting statistics on the IRS, particularly the most recent audit of the IRS. Yes, the IRS does get subject to audit by the folks at the GAO, the General Accountability Office. The reality is that you're going to be surprised when you hear those results. And of course, the latest on Social Security. All topics from last week that bear a little bit more conversation on the program this week because of the headlines that we were talking about last week on the program. But now this week, it's kind of like, okay, well, let's talk about the impact a little bit more of those headlines. Chief among them was the inflation reading dropped down to 5% in the week prior. That's, of course, good news, right? But the bad news is that inflation rate determines a few things. First of all, it determines what the rate is that is on those I-bonds. If you remember, I-bonds heavily talked about last year because I-bonds, which are series bonds issued by the U.S. government, they have an interest rate that is tied to inflation. So last year's sort of sensation getting a lot of conversation, particularly when those I-bonds were hitting 9.62% interest. And that rightfully so. During the course of last year, banks still, for the most part, paying anywhere from 0.25 or 0.5 or maybe not even that much. But then you have this thing that's issued by the U.S. government. Well, my goodness, that's paying 9.62%. And getting a lot, we were getting during that period of time a lot of questions about, okay, what is that? How's it work? And those kinds of things. If you're interested in learning more about I-bonds and how they work, check out some of the old podcasts on our various platforms, and you'll hear us talking about them at length. But remember, 9.62%. How an I-bond works is that it changes every 6 months based upon inflation. So that 9.62 was only good for May through October of last year. For the current period, which would be November through April, that rate on those I-bonds declined to 6.89%. Well, given that it's April, that must mean that next month that interest rate is going to change again, because that's how I-bonds work. It's not like that interest rate is set. It changes every 6 months based upon what inflation. Well, based upon the most recent data that came out, not this past week, but the week before, 5% inflation, that's going to, or it's estimated that that's going to translate to an interest rate on these I bonds that drops all the way down to 3.4%. Folks, that's less than what most money markets are paying these days. Most money markets, 4.5, sometimes even a little bit higher than that. But your I bond now dropped all the way down to 3.4%. Now, that's the estimate. That's not the official number, but based upon where things are, it seems like that's going to be the prevalent rate. So that's a problem, right? That's a little bit of an oops, because with an I bond, one of the restrictions on an I bond is that you cannot liquidate that within the first 12 months of ownership. So if you're like, wait a minute, this thing is down to 3.4%, and so now I want to flip that over to a money market because, hey, the money market's now paying more, so I want to do that. And if it's in the first 12 months, you can't, because that's one of the limitations on an I bond. Similarly, if it's within the first 5 years, then you will incur a penalty of losing 3 months of interest should you want to decide to do anything differently with that. So I bonds got a lot of conversation last year during that 6-month window with the interest rate on those things really spiked up. But as is always the case, there's always sort of a catch, right? The interest rate changes every 6 months, and the interest rate is actually changing to dip lower than what your current money market rates are. So always a little bit of a catch on those. If it sounds kind of too good to be true, well, that one still was a valid rate for that 6-month period of time. But the catch is that it's tied up for at least a minimum of a year, but there's also a penalty if it's within the first 5 years. So that's the latest update as it relates to inflation and I bonds. We'll shift gears because the inflation data has a big ripple effect, not just on I bonds, but on our favorite Social Security. The reality is that after that's another area of impact that is directly impacted by what the inflation rate is, right? Your Social Security cost of living adjustment this year, 8.7%, obviously reflecting high inflation. Well, as inflation starts to creep down, then it is estimated that the COLA for 2024 is going to be quite a bit less. Now, the official estimates for what the COLA is going to be for Social Security don't start until next month in May. But based upon where things are, there's some early speculation that the COLA for 2024 for Social Security is going to be well below 3%. So we literally go from like 8.7 all the way down to potentially less than 3% just on this little bit of movement that we've seen so far on the inflation data. Obviously, that's a stay tuned for more kind of conversation because the official estimates haven't started on what that COLA for 2024 could be. But if you think about the inflation data and how it can ripple through in different places, don't forget that Social Security COLA adjustment as well, because that one is one that certainly a lot of people see. Certainly a lot of folks were pleased to get the 8.7% COLA adjustment for this year. But if you're thinking that's going to repeat itself, highly unlikely. When we come back, we're going to talk about a little bit of a follow-up on the IRS, more particularly the results of the latest audit of the IRS. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Further follow-up to the end of tax season that happened this past Tuesday on April 18th. Yes, it was April 18th. The 15th fell on a Saturday. Then there was a holiday on Monday in Washington, D.C., and the tax deadline is April 18th. You know, many folks that owed money to the IRS expected that to be debited on Tuesday. A little bit of a backlog in the system, so sometimes you saw that debit not happen until Wednesday or Thursday. Interestingly, though, I mean, everybody, of course, fears an audit from the IRS, but who does the IRS fear? Who audits the IRS? Did you ever kind of think about, well, who's kind of looking at how they're doing their operation? And if there is somebody, well, how are they doing? Well, there is somebody who audits the IRS. That's the folks at the GAO, the General Accountability Office. And the results of their latest audit probably not going to strike you as being all that good. So we'll talk about that on the program in this particular segment here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of good folks who also happen to be certified financial fiduciaries who stand ready this week to help you change your life with a successful and cost-effective financial plan. Make sure you subscribe to us on your favorite podcast channel of choice, or maybe over there on YouTube as well. You have any problems finding our channels on any of those platforms, go to our website, nelsonfinancialplanning.com. You'll see a bunch of icons in the upper right-hand corner. Click on any one of them and you will get directly connected to our channel. Once there, make sure you subscribe. So this data comes to us courtesy of a Wall Street Journal article that delved into the audit of the IRS performed by the GAO. Particularly, this audit, some of the findings of it were particularly startling on the technology side of things. I kid you not with the following statistic. Listen to it closely. Nearly a quarter, 25%, of all the applications that the IRS was running were 25 years or older. 25 years or older. Quarter of all applications that the IRS is running over 25 years of age. Take a minute and sort of take stock of that. Like, what did your cell phone look like 25 years ago? Oh, wait a minute. There wasn't a cell phone 25 years ago. It was a landline. I mean, can just stop and imagine that this is the technology that the IRS is using 25% of the time in terms of looking at all of its technology systems. 25% of them are 25 years or older. Pretty shocking, right? Perhaps instead of hiring 80,000 new agents, maybe you should have taken some money and, hired like some software engineers or something like that to maybe update some of this stuff. Can you imagine running something that's 25 years old? I mean, it's just mind-boggling when you stop and think about that. But if you think that's bad, wait till you hear these statistics on Social Security, which last week we discussed. Again, the latest report that says it's quote-unquote running out of money a year earlier than originally expected. Remember, running out of money doesn't mean the same, as it would to you and me. When we talk about the Social Security, they're not really running out of money. They're just not going to be able to pay the same level of benefits that they would be. But the reality is that they still, just like the IRS, have a massive backlog and also from the pandemic, and also outdated systems as well, which, again, not good considering that you got like 10,000 baby boomers a day becoming eligible for retirement benefits under Social Security. Pretty staggering numbers that's happening on a regular basis, especially with a government agency that maybe not quite as bad as the IRS that's running all those old applications, but at the end of the day, certainly very far behind, not very efficient, and using a tremendous amount of outdated systems. Here's the numbers for the Social Security as well. So since 2010, so over the course of the past 13 years, Social Security has acquired 21% more beneficiaries whose ranks have grown from 54 million to 65 million, right? That has to deal with more people retiring each and every day. Unfortunately, though, during that exact same period since 2010, the budget for Social Security, the administration's budget, dropped by 14% after adjusting for inflation. So having to basically deal with 21% more beneficiaries, but effectively a budget that's valued at 14% less. Social Security now has 60,000 workers, its lowest staffing level in 25 years, and 13% fewer employees available to serve the public than in 2010. Some pretty dramatic and damning numbers when you think about those two large organizations and what they are responsible for. The IRS responsible for collecting the dollars that then the government uses for all of its various programs. Social Security responsible, probably the biggest program that is responsible for paying out those benefits. And lo and behold, we've got some highly inefficient and agencies using incredibly old technology and incredibly old software. That's why when you try and get in touch with any of those folks, it's, crickets, if you will. So the reality is that if we're going to allocate money to the folks at the IRS or allocate money to Social Security, maybe we want to hold them a little bit more accountable to maybe use current technology or maybe focus more on customer service rather than, hey, let's just get a bunch of agents. Not sure that's what we're looking for as an American population, but hey, I digress. Anyway, that was the latest reports of the audits of the auditors, if you will. So certainly something to think about. Another something to think about is when you think about large companies. And obviously, if you're a longtime listener to this program, you know that our investment philosophy really likes to focus on using predominantly large companies, those big giant sort of names that you know. And so, we thought it important to talk a little bit on the program about just how broad that universe is when we're talking about that. And what's interesting is that that's a universe that is much broader today than it was because of the globalization that has occurred, obviously, throughout the world. In fact, if you look at the overall structure of the world, there's over 3,000 companies with net sales of at least $1 billion. Let me say that again. There's over 3,000 companies around the globe where their net sales are in excess of $1 billion. Folks, that's a pretty big company when you're generating those kinds of numbers. So that certainly allows you to create a very well-diversified portfolio. Even if you're staying mostly in that large company area, that gives you an opportunity to really create a very well-diversified. Even if you're only using like 20% of the names, it's still a 500 or 600 company investment portfolio. So when we talk about large companies and the importance of owning large companies, it's not a small pond that you wind up fishing in. It's a very big pond that has only grown much bigger over the course of the past 20 years. Now, the other thing to be thinking about is where are those companies located? Obviously, there's a tremendous amount of them that are in the U.S., but the domination of that has certainly changed over the course of the past 20 years. 20 years ago, 75% of those companies that had those kinds of sales were right here in good old US of A. That's where their headquarters were. If you look at those numbers today, less than 50% of those same companies that have that net revenue in excess or net sales in excess of $1 billion are located here in the U.S. So that begs a question, particularly when it comes to investment allocation and diversification, is in order to kind of have exposure or access to these particularly large companies that make the stuff that the world uses every day, you've really got to have that global component to your investment portfolio. So certainly something to think about when it comes to the diversification of your investment approach. We're going to take a break. When we come back, we're going to talk about that digital currency stuff here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Rumor going on out there, or should I say a suggestion, that somehow digital currency is going to equate to the end of the U.S. dollar. You hear that sort of all over the place these days. Furthermore, and what also seems to be going hand in hand with that discussion is that those BRIC countries that include Russia, China, India, Brazil, they're sort of consorting about to find ways to effectively just replace the dollar and end its reign as the world's reserve currency. There's sort of two different issues there, but we're going to try and unpack them both here on the program in this segment. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Make sure you subscribe to us on your favorite podcast or even on our YouTube channel. We've got a lot of programs out there in our inventory that cover a wide range of topics. So if you have any trouble finding us on your favorite platform, go to our website, Nelson Financial Planning. Make sure you click on those icons that you'll see on the website, and then that gets you automatically connected to our channels. Once there, please subscribe, because then you know when you'll get updates and notifications of when we post new material on those various platforms. So my name, of course, is Joel Garris. I'm a certified financial planner, a certified financial fiduciary at Nelson Financial Planning. So what's this all about, right? The talk of digital currency first. I guess my reaction when I hear people talking about that is, well, isn't the cat kind of out of the bag already on that? I mean, think of how often we use credit cards, how often we use debit cards. And now, over the course of the past few years, there's been a proliferation of cash apps, whether it's Venmo or whether it's Zelle or whatever the case may be. It's very easy to send money from one person to another, and they don't even have to be next to each other. They don't have to be in the same state. I mean, the reality is that certainly when you think about younger generations, very rare for them to really even use cash, right? In a very informal survey, I surveyed my 3 boys in college, and I was like, when was the last time you hit up an ATM? And the answer is not this semester. So the reality is that digital currency is certainly here to stay. It's not going to change. But I think the thing that we forget is, in the past, when we wanted to exchange money and we wanted to exchange cash, right, I would hand you basically what was a piece of paper, right? And on that piece of paper was a picture of a dead president and usually like a number, like if it was a $20 bill and there was 20 on it, it was $50 bill, was 50 on it. Now, instead of sort of handing you that piece of paper with the president pictures on it and the number on it, I just tap my phone or I hit a button on an app and off it goes. Anywhere in the world, you don't have to be next to me to receive that piece of paper. Instead, it's just an application. But underlying that is that level of faith or level of trust, if you will, that backs the U.S. dollar by the full faith and credit of the U.S. government. When you look at a printed dollar bill, or $20 or $50 or whatever the case may be, you will see that there's a name on it that says that it is a Federal Reserve note. Well, what's a note? A note, after all, by definition, is a promise to pay. So when you have a $20 bill in your possession, what you have is a promise to pay by the Federal Reserve the equivalent of 20 U.S. dollars. It's a promise that's pretty good. Ultimately, digital currency would operate on sort of the same premise, right? If I send someone $100 through Venmo or Zelle or whatever the case may be, it's kind of the same thing. The reality is that instead of giving you a piece of paper, like before when I would hand you a $20 bill, then I'm giving you a digital certificate. They still represent the same thing. I mean, and I think that's the important thing. It still represents the same thing. It's still U.S. dollar. So whether the dollar is printed on a piece of paper with a dead president and a number on it, or whether it's certified through a digital certificate of transferring money from me to you, it's still U.S. dollars. There's no suggestion, the notion that you're replacing the U.S. dollar with, say, wampum is just doesn't really get there, because just as sending money on a cash app is the U.S. dollar, so too would the digital dollar be. The only difference is that it's no longer printed. So that's really kind of where that discussion is. And the cat's clearly out of the bag on that one. We're not going back to that. The reality is that instead of exchanging pieces of paper, we're exchanging digital certificates, both of which effectively still mean the same thing. That's still the U.S. US dollar. That's not just something different, and they're not going to go in and like replace it with wampum or something like that, because the reality is that the paper represents the dollar, the digital certificate represents the dollar. So where this conversation, I think, sort of starts to go off the rails a little bit is it seems to suggest that this is going to spell the end of the US dollar. And it sort of ignores sort of the current reality, or the reality of the current usage that's effectively already here. But it also seems to suggest that somehow then that means of exchange is going to be a means of exchange for something that's other than the US dollar. And that argument just completely ignores the fact that the US dollar still is and remains very much in the strongest position as the world's reserve currency, because the suggestion that its usage or prevalence is somehow in decline sort of ignores current trends and positions. First, if you think about foreign exchange markets, where currencies are traded back and forth, the US dollar, is involved in nearly 90% of all transactions. Most recently, over the past 10-year period, the dollar accounted for 96% of trade invoicing in the Americas, 74% in Asia Pacific, and 79% in the rest of the world. I ask you, does that sound like a currency usage that is in decline? We would argue no. Second, consider what our Federal Reserve just did during the course of the most recent global crisis, that being the pandemic, especially in comparison to what they did previously in the prior global financial crisis. In 2008, 2009, the Federal Reserve stopped short of backstopping foreign denominated assets, bonds, etc. In 2020, during the COVID shutdown, Federal Reserve did just that, went much further in terms of the types of assets that it would backstop versus what it did even in what we would submit as was a much more dramatic financial crisis during 2008, 2009. The fact that it went even further in 2020 than it did in 2008, 2009, in our view, continues to secure or cement the position that truly the US dollar is the world's dominant currency, its reserve currency, especially when you think about, well, just in recent history, it went further than what it did previously in terms of backstopping foreign denominated bonds. But so again, relative position, okay? And so that certainly, when you think about the statistics, it doesn't appear that it is a currency on its way out or in decline. In fact, if you think about what the Federal Reserve did, you could certainly strongly argue that it is actually more powerful than ever before. Now, the next part of the conversation has to do with the BRIC stuff, okay? Consider, first of all, that hill that they have to climb. 80% of all global transactions denominated in US dollars. Set that aside, and everybody seems to do when they're having this argument. Let's talk for a minute about a couple of those folks. Russia, China. Last check, authoritarian governments at best. Some might effectively argue a dictatorship. When you think about that from a business perspective, you're not going to engage in currency that's subject to that kind of uncertainty. And that's where the argument really falls apart. We're going to take a break and kind of finish up that concept here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Finishing up the conversation from the last segment of the program here, talking about digital currency and the suggestion that the U.S. dollar is in decline. I think that completely ignores its relative positioning. 80% of all global transactions denominated in U.S. dollars. Certainly not a currency in decline, particularly when you consider that the Federal Reserve went much further and positioned itself even more so as the world's reserve currency, particularly in the last economic crisis. During the COVID shutdown in 2020, Federal Reserve went even further in terms of backstopping foreign-denominated bonds and the like than it did in the 2008-2009 crisis. So when you look at the totality of what actually is happening, there's clearly a dominant position of the U.S. dollar that is not going the other way. And the suggestion by folks that the folks in the BRIC regime, Brazil, Russia, India, China, somehow are consorting to find a replacement to that reserve currency. Well, they probably are consorting to find a replacement, but they've got a couple of problems and obviously a pretty big hill to climb when you consider the statistics of just what the relative positioning is of the U.S. dollar in the world's global economy. Similarly, let's just take a moment and think about a couple of those parties in that whole consortium, right? So Russia, China, at last check, those were authoritarian governments at best. Maybe you could even argue somewhat of a dictatorship. So what happens if you get on the wrong side of those? Well, I think history, particularly over the past few years, is pretty full of examples of if you get on the wrong side of the equation, whether it's in China or Russia, you get jailed, your business gets taken over. I don't know that I need to go into a full listing on this, but I mean, in China, the list of CEOs that have somehow disappeared and industries that have sort of gotten evaporated, think private tutoring industry, things like that. I mean, all it takes is to get on the wrong side of the equation. And then Russia, I mean, how many billions of dollars of assets did it seize as a result of its movement into the Ukraine, right? I mean, some of these companies lost literally billions, particularly oil companies, things like that, just billions of equipment. In that type of an environment, right, that level of instability and uncertainty really does crater the argument that somehow any business is going to ultimately be comfortable relying as extensively on a currency from those countries, because it's not going to be a reliable means of an exchange. And that is the core of any business transaction, that you have a reliable means of exchange that can be effectively sold, effectively valued, and effectively come to terms. And the reality is that that reliable means of exchange is crucial to any business transaction. And despite all of our flaws, and by no stretch of the imagination is it perfect here by any stretch, the U.S. dollar remains unrivaled in the global landscape, whether it's the number of global transactions and simply the mere stability. And as much as we like to sit around and say, oh, it's so unstable in Washington, and certainly we talk about that on the program here, but it is different. And it is different, particularly in comparison to Russia, in comparison to China. And that simple fact underscores the reality of what a business transaction is all about. It's an exchange between two independent and two willing parties, but they need to know that the means of exchange is a reliable means of exchange. And that reliability isn't there, particularly when you consider the form of government in a lot of those countries that are working to try and come up with these alternatives. So some thoughts on that, if you will. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. We'll end the program with some interesting stats about retirement that maybe you did not know. First and foremost, though, it can last longer than you think. And the reality is that when we think about the mean retirement age in America is about 61 years of age. If you look at the current life expectancy as a whole, you'll find that that number is a little over 76 years. So if your average retirement is at 61 and the life expectancy is 76, that means that on average, your retirement is going to be 15 years if you look at the data that way. However, when you look at the data from a 65-year-old's perspective, because when you think about life expectancy as a 65-year-old, it's a different number. Why? Because they didn't die in their 20s in a car crash. They didn't die of cancer in their 40s and 50s. They made it to 65, and that means that their average life expectancy is in fact well past what that mean average of that age 76 is. So if you look at the statistics, a 65-year-old woman today has a 50% chance of making it to nearly age 87. That's a 22-year long retirement. Similarly, a 65-year-old man has a 50% chance of making it to 84. So retirement can in fact be much longer than sort of the averages that you hear and the average life expectancy and all those kinds of things. So bottom line, what does that mean? That means that from an investment perspective, an ultra-conservative portfolio that's sitting predominantly in cash or sitting predominantly in bonds isn't going to work over a 20 to 25 year period of time. There still has to be some component of growth in any portfolio, even when you are in retirement. Otherwise, you're not going to be able to stay up with inflation. You're not going to be able to stay up with taxes. You're not going to be able to stay up and get that growth you ultimately need over time. Bottom line, when you think about retirement and the fact that it does in fact last longer than the averages for a lot of people, you still need to be balanced. You still need to be diversified at all times and at all ages. You just can't go all cash or all bonds when you get to retirement. That's not going to work, because retirement, you're going to find, is going to last much longer than you think. Number two, and it bears no further explanation, but Social Security isn't going to cut it as your sole source of income. So average monthly check of Social Security, about $1,800. That only provides a standard of living to satisfy you if you were in the bottom quartile of income earners. So the reality, of course, is that yes, you've got to save money along the way. Make sure that you're also doing what needs to be done to fund your retirement. Start small. We talk about this all the time. $50 a month, $100 a month, whatever the case may be. Start small and then build from there. It's okay as long as you've at least started. Those are the most important things to be thinking of. We got a couple of other thoughts, but we're going to save those for a future program in terms of some of those retirement statistics that might surprise you, because we're going to wrap it on up and get on out of here. Thank you all for listening to the program. That's about it for this week's episode of Dollars and Cents. If you like what you heard and want to learn more, make sure you go to our website, nelsonfinancialplanning.com, and check us out for more information on how we can help you improve your life with a cost-effective and financial plan. Or just give us a call at the office this week, 407-629-6477. Enjoy the rest of your day.